Welcome to the Deep Dive, the Talk Tickers edition. We're here to break down complex corporate earnings into insights you can actually use.
That's right.
Today, we're talking Blue Foundry Bancorp, that's ticker BLFY. We're digging into their Q3 2025 earnings call from October 29th.
And our mission today is pretty specific.
Yeah, it really is. We need to understand how this bank is, well, losing money on paper, but seems to be pulling off this balance sheet turnaround that management sounds really confident about.
It's a classic good news, bad news situation, isn't it? The headline number, the loss, grabs your attention.
Yes.
But underneath, management is actually making these structural changes that could unlock a lot of value down the road.
So the key thing for you listening is that BLFY seems like a story of maybe delayed gratification.
Exactly. We really need to focus on those structural shifts, the things happening in 2026, because that's probably where the real story, the real value is hiding.
Okay, let's start with that snapshot then, the top line numbers. Because this is where the tension really lies, I think. BLFY reported a GAAP EPS loss. It was $7.10 per diluted share.
Right. And that was dead on consensus. So, not a shocker on that front.
No surprise there. But the revenue side, that looked a bit better.
Yeah, it did. If you use the Zacks methodology, revenue landed at $12.61 million. That was a modest beat, actually.
Okay.
And what's really notable is that it's up 33% compared to last year. You got to give them some credit for that kind of growth.
True, 33% is significant still. They ended the quarter with a net loss of $1.9 million. Now, that loss did shrink a bit from the previous quarter, which is good.
A positive trend, yeah.
But the market reaction, it seemed kind of cautious, right? Why the pullback if revenue grew 33%? What's the market telling us?
I think the market's just impatient, plain and simple. Yeah, there were operational improvements, and we'll definitely get into those, but the street wants to see a clearer path, maybe a faster path to actually making money consistently on a GAAP basis.
Right, they want profit, not just progress.
Exactly. So the win for now is the margin expansion, the balance sheet growth, but the market's saying, okay, great, but show me the bottom line profit. And soon.
Okay, let's unpack that margin story then. Because for any bank turnaround, that net interest margin, the NM, that's the engine, right?
Absolutely. NM is basically the difference between what the bank earns on its loans and what it pays out for deposits and funding.
And how did BLFY do there?
They managed to grow it. NM expanded by 6 basis points just from the prior quarter, hitting 2.34%.
6 basis points? Sounds small, but it means they're getting better at their core banking job. What was behind that?
2 main things. First, their asset yields, what they're earning on new loans, ticked up by 9 basis points.
Okay.
Second, and this is pretty important, their cost of liabilities, what they pay depositors, actually went down by 4 basis points. In this environment, that's a strong sign of good balance sheet management.
So less cost, more yield.
Pretty much. And all told, net interest income came in at $12.2 million.
And if we, zoom out a bit, that quarter-over-quarter gain is nice, but the year-over-year picture.
Oh yeah, year over year really shows the structural change. NI is up a whopping 52 basis points compared to Q3 last year.
Wow, 52 basis points.
That's the real proof point for their turnaround story, I think. It shows they are successfully repricing their assets and liabilities and maybe benefiting from funding costs starting to ease up across the industry.
Okay, so how are they funding this? Let's talk deposits. They grew total deposits by $77.1 million in the quarter.
Right. And the core deposits, the cheaper, stickier checking and savings accounts, those were up $18.6 million.
And management seems pretty active here. They're moving away from CDs, certificates of deposit.
Yeah, they're deliberately shifting away from those more expensive CDs. They seem to prefer money market products now.
Okay.
And they're also using brokered deposits, but strategically, it sounds like. Using them to manage overall funding costs and make sure they have the cash needed for the loans they want to make. It seems quite disciplined.
It sounds like a positive trend, but you mentioned the market's impatience. Is there a catch, a timing issue?
There is, and management basically confirmed it on the call. They expect Q4 NIM to be, relatively flat.
Flat, after all that progress.
Yeah. It seems the biggest benefits from loans repricing at higher rates that's mostly pushed out. The real acceleration in earnings probably won't show up until 2026.
Okay. So that's the waiting game. That's the overhang on the stock price.
That's likely a big part of it, yeah.
Which brings us nicely to the other side of the ledger, the loans. What are they doing with their loan book? Total loan growth was $41.9 million. What stands out in the mix of those loans?
The mix shift is really the big story. They originated a decent chunk of commercial loans, about $81 million, but they also had significant payoffs there.
Okay.
But what grew nicely was the consumer portfolio. That was up $38 million.
And they grew that consumer side mainly by buying pools of loans, right? Loans that already had some credit reserves built in.
Exactly. For you listening, that basically means they're buying assets that have sort of built-in cushion or discount for potential future losses. It lets them boost yield, hopefully more safely.
Smart. So what's the overall strategy pivot here?
It's pretty sharp. They're really focusing on building full relationships with small businesses. That's C&I, commercial and industrial lending, and also owner-occupied commercial real estate, or CRE, where the business owner actually uses the building.
And what are they moving away from?
They're actively stepping back from multifamily CRE, apartment buildings. That's been a source of headaches for a lot of regional banks lately.
Makes sense. Focusing on higher yielding C&I and consumer stuff should help drive returns and NIM later on.
Yeah.
Seems like they're cleaning house.
They really are. And their current loan pipeline kind of proves it. It's over $41 million in letters of intent, and the average rate on those is above 7%. That's a good return.
And the multifamily exposure in that pipeline?
Minimal, less than $6 million. So yeah, they seem to be walking the talk on shifting that loan mix.
Now, what's really interesting to me is the capital allocation. While they're posting these GAAP losses, their tangible book value, the TBV, actually went up to $15.14 per share.
Right.
And at the same time, they bought back a ton of stock, over 837,000 shares, at an average price of just $9.09.
Yeah.
Wait a second. They're losing money, but buying back stock way below book value. How does that work?
It sounds weird, but it's actually a huge vote of confidence for management. They're essentially buying back a dollar's worth of the bank for, 57 cents?
Yeah, roughly.
By doing that, they shrink the number of shares out there, which boosts value for the remaining shareholders. It strongly signals they think these GAAP losses are temporary and that they have enough capital cushion to make this move.
Okay, that makes sense. It's a value play. But let's talk about the potential fly in the ointment, credit quality. Non-performing loans, NPLs, they jumped quite a bit this quarter.
They did, yeah. That's the number that probably raised some eyebrows. NPLs went up to $11.4 million, which is 66 basis points of total loans. That's up quite a bit from $6.3 million or 38 basis points last quarter.
That kind of jump usually gets the market nervous. What drove it?
Management said it was almost all down to one single loan, a $5.3 million multifamily loan that got moved into the NPL category.
Okay. One loan, but they said they don't expect to lose principal on it. Still, a $5 million credit going bad. Does that worry you, especially given their move away from multifamily? Could it be a sign of more trouble?
That's the question, isn't it? It's definitely a risk factor you can't just brush aside. But on the positive side, their provisioning seemed pretty disciplined.
How much did they set aside?
They provisioned $589,000 for credit losses. And interestingly, they said this wasn't mainly because of actual loan losses right now, but more due to worsening economic forecasts they have to plug into their models.
So being cautious based on the macro outlook, not necessarily a disaster in their own portfolio yet.
Seems that way. Prudent, you could say.
Okay, shifting gears slightly, non-interest expense, that ticked up too by about $347,000. Why was that?
Mostly higher compensation costs and also some increased spending on professional services, probably tied to these strategic projects they're working on for the turnaround.
Right. Not ideal for the bottom line right now, but maybe necessary spending if it fuels the turnaround.
That's the trade-off. But let's pivot back to the really big positive driver here, because honestly, for you listening, this is probably the most important thing from the whole call. This is the 2026 story.
Okay, hit us with the numbers that matter. What's the structural tailwind?
So management really hammered home the scale of the loan repricing that's coming. Think about their loan book like it's full of old contracts signed when interest rates were super low.
Right, pre-rate hikes.
Exactly. Well, a big chunk of those low-rate loans are about to mature and reprice higher. Specifically, about $45 million worth of loans that are currently yielding below 4%. Those are scheduled to reprice in the first half of 2026.
$45 million bucks, jumping from sub 4% potentially up to current market rates, maybe over 7%. That's a huge automatic boost to their income.
Massive. And that's just the first 6 months of 2026. There's another $35 to $40 million currently yielding even less, sub 3.75%, that will reprice in the second half of 2026.
Wow.
And this isn't just a forecast, right? This is baked into the existing loan contracts. It's a fixed structural catalyst. This is what the market is waiting for to see that sustained profitability kick in.
Okay, so putting it all together,
Yeah.
the investor context makes perfect sense now. You can see why BLFY stock has lagged behind the regional bank index, the KRE, and the broader market.
Yeah, the slow path to actually realizing that 2026 profit is the big overhang.
So the core conflict is management's message is, look, we're executing operationally, NIM's up, TBV's up, buybacks are strong.
Right, trust the process.
But the stock price is effectively saying, yeah, nice process. Show me the actual TAP earnings.
Exactly. And until that $45 million first waves of repricing actually hits the income statement in early 2026, the stock's probably going to struggle to get full value. It'll likely trade at that deep discount.
So before we get to those 2026 fireworks, what are the key checkpoints? What should you be watching the next few quarters?
I'd watch two main things. First, can they keep growing those core deposits? They need that cheap funding base.
Okay.
Second, track the progress on that repricing. Is that $45 million bucket actually repricing at the high rates they expect when the time comes?
Got it. So your final take.
Look, I'd say it's cautiously constructive.
Yeah.
The bank is executing on important operational things, NIM, deposits, TBV growth, the buyback. But you can't ignore the JAP losses still being there and that recent jump in NTLs, even if it's just one loan for now. Investors need to stay watchful.
Okay. That leads us perfectly into our final segment. This is not financial advice. A quick reminder. Everything we're about to discuss is purely for informational and entertainment purposes, based solely on the earnings call data we've just dissected. Don't take this as investment advice.
Definitely not. But if we were hypothetically pitching this to an investment committee, this setup allows for a pretty aggressive, though hopefully grounded, trade idea. It's focused squarely on value realization, not on immediate earnings growth.
All right, lay out the hypothetical pitch for us.
Okay, the core thesis is BLFY is just too cheap relative to its assets. The stock's trading around 57 cents on the dollar of its tangible book value, $8.56 share price versus $15.14 TBC.
That's a big discount.
It is. And management is proving their confidence by aggressively buying back stock at $9, at 99 cents, way below that TBV. That signals they have the capital and believe in the underlying value. Now, we know the big earnings catalyst, the NIM expansion from loan repricing, is delayed until 2026.
Right, the $45 million plus another $40 million later.
Exactly. But knowing that's coming provides a huge margin of safety structurally.
So you're betting on the math, the asset value, and that future repricing event, not on near-term sentiment changing dramatically. How would you structure a trade around that?
The idea would be to go long BLFY equity, buy that discounted value. But to maybe hedge out some of the general banking sector risk, you could finance that long position by simultaneously shorting a different regional bank.
Which kind of bank?
Maybe find a peer that's already seen its stock price recover quite a bit, so its valuation multiple looks richer, and crucially, one that still has significant exposure to that riskier multifamily CRE that BLFY is actively shedding.
I see. So you're isolating the BLFY specific story. You hedge the sector noise, but make a specific bet on BLFY management executing this repricing schedule and avoiding any major credit blowups, especially from that one NPL.
Precisely. The rationale of that deep discount to tangible book combined with that massive locked-in structural tailwind from the 2026 repricing. If they can just navigate the credit side, okay, the path for the stock's multiple to improve as that $45 million hits the P&L seems pretty clear.
So it's a bet that plays out in 2026.
It's fundamentally a 2026 story. The trade idea is about getting into position now, while the market is still maybe overly focused on the flat Q4 NIM guidance. You're buying next year's potential catalyst at today's somewhat pessimistic price.
A 2026 story bought at a 2025 discount. Interesting idea. Okay, let's quickly recap the main points from our deep dive today. BLFY delivered that inline EPS loss, but beat on revenue.
Showed really strong year-over-year NIM expansion, a big positive sign.
Signaled a major strategic pivot in their loan book, away from multifamily CRE towards C&I and consumer.
And backed their belief in the bank's value with those aggressive share buybacks well below tangible book value, despite the ongoing net loss.
But the key remains that 2026 repricing schedule.
Absolutely critical. For you listening, the thing to watch now is how that balance sheet repricing actually plays out. If that first $45 million wave reprices as expected in early 2026, the whole earnings picture for BLFY could change very quickly.
So maybe do some homework. We encourage you to look into funding trends across the regional banks, compare their CRE exposures, and see how BLFY's provisioning stacks up against its peers.
Good context to have.
All right, that wraps up this deep dive from Talk Tickers. Thanks for tuning in.
Thanks, everyone.
And remember, we analyze the data, but this is not financial advice. Do your own research.